Good evening to all, and welcome to our series of webinars where we try to help you out about the possible roadmap for the month-on-month basis, the derivatives action. This webinar, we will specifically try to address how we are looking at the June month. In our last three webinars, we have been on the point where we were expecting a pullback rally, and happy to share that we have got it absolutely right in terms of the recovery which the market has had. Now, what's the way ahead for June is what we are looking forward to. So, first of all, if you look at the May series which went by, we had an exceptional positive month again. 587 points up over the prior series in the May month. So this is the third consecutive month where Nifty has seen straight gains. We are moving out of a volatile phase. If you recollect, 4 or 5 months back, the markets were in very bad shape. There was the tensions, border tensions, Indo-Pakistan escalation. There was tariff wars, and after all these different kinds of scenarios where possibilities would have been much bad for the market, the Indian markets have been very resilient, and today we have overcome all these barriers and standing strong at the levels of 24,700. So the positive part here is the India VIX, which we say is the volatility index. It has cooled below 18%. It is at 15.78%. VIX made a high of around 25% when things were not in shape in the last couple of months, and at 15%, it is with good confidence you can say that the stability is getting back in the system. Now, if you were to look at the rollovers for the Nifty, the positions which have been carried over from the May series to the June month, the rollovers were around 79% compared to the average 3-month rollover numbers of 80%, which means that majority of the long bets in the system continue to stay as they are, and the positive sentiments from the May month are carried forward to the month of June as well. So overall, the positioning as far as the broader market goes in the Nifty continues to be positive. The options data, even if you were to look at the broader market for the options, if you actually look at the price actions in the last 5 to 15 odd trading sessions, the markets have been in a broader range. Somewhere 24,450 is a kind of a support zone which the markets have been respecting in terms of the price action, and at 25,000 you are seeing some bit of a resilience. Now, with the technical parlance, we call this more of a time correction, because if you look at the entire action in the market in the last 3 months, it was a one-way rally, and it's time that the market takes a breather, takes time to chart out its next course of action, takes time to see and digest all the news factors before the next directional move takes place. So right now it's a range bound or a neutral setup which the markets is in right now, and how to approach with such kind of a range bound scenario is what the webinar is all about. So the view from the broader perspective is positive. It is just that if you were to micro time this in terms of the trading action, what would be the appropriate levels one should look forward to is the key. Now, 24,450, which is the important level here, which again has been respected today, would hold a key ahead of the bank policy, which starts from tomorrow. Now, picture this: if this support of 24,450 is broken, then one should be prepared for a 300 to 400 points fall, where a possible chart gap scenario which we had noted at the levels of 24,100 that may get filled up. So that is one probability or a scenario analysis which one should work with. And the another factor is how the data is playing out in this range bound action in the last 10 days. So if you were to correlate this with a piece of the FII action which has been prevalent in the last few trading sessions, the FII short positioning is gradually picking up since the last 5 trading sessions. So that's a slight a red mark for the market, a slight caution which comes into play. It is not that we are saying that the markets will reverse here. It is a small corrective action, which is a normal market behavior, you may view it positively as another opportunity which the market offers you to buy at a lower level. So in case 24450 breaks, be prepared for levels of 24,000. What is happening in this range? Shorts are slowly piling up. That is what the data has to say. Now, Bank Nifty, which has been also range bound for the entire May month in the range of 54,000 to 56,000, has seen more or less a neutral kind of a rollover scenario with 79% rollovers compared to 78%. So that's more of a neutral or a long rolls which have continued in the system. Traders eagerly watch as to how the RBI would keep its stance in the MPC policy which is there tomorrow. So that will be keenly watched. I think Friday will be the day when we will get to know exactly how the market reacts post the RBI event. Now, specifically speaking about the FII data here, I have two sets of data for you. One is the cash market data in the top tabular form, and lower you have the index future data. If you look at the last 3 months, March, April and May, the numbers have been very positive both from the FIIs and the DIIs. In fact, May month was the month where the Indian market saw around 11,000 odd crores of buying in the cash segment. So that's a very strong number, because if you were to compare the averages month on month, a serious jump from around 2 to 3,000 odd average, which you see month on month gain, to suddenly 11,000 just speaks volumes of the FII buying in the cash segment. If you were to see the action in the index future segment somewhere, it has a different story to tell, because in the month of May, there have been shorts which have been slowly piling up in the system, and the long short ratio also has significantly come down, which I will show you in the next slide of my presentation. But May month saw 15,000 crores of short positioning in the market, especially in the index future segment. So broadly, you can conclude looking at this data is that the Nifty or the indices are moving now at a gradual slow pace. There is some distribution activity which is evident, and the small and the mid cap space is where majority of the buying is seen, which has seen a good a positive number from the FII data. Also, if you look at the long short ratio, which I spoke of, it is currently at around 17%. If you recollect, in the recovery rally which we had in the last couple of months, this long short ratio was around 40%. Today we are at 17%, which really means that majority of the longs from the FIIs are liquidating their bets in the future segment, and even shorts are slowly piling up. So a slight word of caution if you are trading for June, that a range bound scenario which is playing out has to somewhere show a direction before you decide on the next course of action. So right now, sector wise, what we saw in the rollover data for the month of June was that the auto, the metals and the infra, these were the three top sectors which noted long additions or positive rollovers from the May series to the June month. So stock specific action, if you were to look at the auto names, autos have staged a very strong bounce back. Even stocks to the likes of Tata Motors, which has borne a serious pain in the market in the last 5 to 6 months of trading, has seen some good serious recovery and is all setting up again to move for levels of 800 plus. Bajaj Auto, Tata, then you say Hero Motocorp, TVS Motors. These are other names also which has shown good intent of a recovery or a bounce back, and we have seen long additions. Metal space has made a surprise move. A lot of long additions are piling up. Last 2-3 months have been exceptionally well. The percentage recoveries in most of the metal names like a Tata Steel, a Steel Authority of India, a Jindal Steel and Power, all these names have registered significant percentage-wise growth month on month, and these long positions continue to be shifted to the June series, which show a positive tinge. Similarly, the infrastructure sector led by Larsen and Toubro are showing good positive traction for the month of June as well. Now, OI placement is where the options concentration is distributed for the month of the June series. Now, if you were to look at the monthly series which expires on 26th of June, the highest concentration of puts is at the 24,000 strike, which we attribute to put writing. Considering the fall in the VIX in the last 5-6 sessions, the support base which the market clearly charts out is 24,000. So the belief is 24,000 support is there to stay. That's where the option put writers are comfortable to sell, considering that markets won't drift below the 24,000 mark. Also on the upside, 25,000 is the resistance zone, and that's the point where call writers are comfortably placing their writing bets, which gives you a complete box type of a range, a 24,000 support and a 25,000 resistance for the month of June. So the initial feelers are looking at the options data for the June series are that it's most likely to be a range bound month as it has been. Yes, considering the last 15 days of range bound behavior of the market, there may be a slight jerk, a knee-jerk reaction. Possibly, if I were to punt which way it could go, the initial gut feeling is it might go on the downside, considering the short build-up which we are noting from the FII data. So there are chances you might have a slight knee-jerk reaction till 24,000, which I see as a good buying opportunity in the market. So right now, the long-short ratio from 16% in March, it moved to 40%, then 41%. We are back at around 20%. So that's the only concerning part. Clients still have long exposure in the market. Around 60% of the long exposure, mainly in stocks, is what we are looking at from the client side. So keep some key levels to watch would be there is a typo error here. It's not 23,400. It should be 24,000. That's an important support zone from an entire June month perspective. And on the resistance side, 25,200 is the immediate hurdle, and 25,500 would be the next set of hurdle in the current market scenario. Now, there are 2-3 things which one needs to keenly follow if you are also following the news flow at the same pace with the market. Now, the quarterly earnings are almost done and dusted. Luckily, we had a quarterly earnings season where even the negative effects of the result season were absorbed by the market, and majority of the stocks have come out very strongly. Even muted result reaction have seen good pullback price action in most of the stocks. So eventually, even if you see at the broader market setup, things are slowly improving for the market, and we are out of the situation which we were 5-6 months back, where we were staring at a war scenario or a tariff scenario which would have serious repercussions on the market. So those pain points are at our back. We are looking markets positively. It is just about timing, which is the right price to buy the index and the stocks is what matters for the month of June. So look at the RBI policy, which is there on 6th of June. It starts on Thursday, tomorrow, and by 6th you will have the outcome. So that should just set the tempo for the Nifty and the Bank Nifty index. Second, the tariff updates. Yes, that's a concern, but I think that's behind our back right now. I don't see this more of a serious threat. You will have some news flow in and out, but really that shouldn't bother the markets much. At least the volatility index at 15% has a lot to say that the fear is behind our back. And the monsoon update. So luckily you are in a phase where the monsoons have hit in India well before its date. We have started with good rains from 20th of the month. Normally 15th and 20th of June is where the rains hit India, but this time rains seem to be on track. So it seems that it should all augur well for the Indian markets. So overall, if I were to look at the month of June, it seems that the markets will trade in a range. 24,000 on the lower end, 25,200 on the upper end. These are the levels to watch. Micro timing is this, where I will buy the Nifty. First, if it breaks 24,450, be prepared for a slight knee-jerk reaction to 24,000. Nothing to be scared of. It's just a small support break, and things should steady back again at 24,000. So if supports reach 24,450, slight sell trigger, but again re-enter buy positions at dips of 24,000. If supports of 24,450 don't break, once again you can have a scenario where 25,000 can be in the making. But broadly, I do not see markets going beyond 25,200 at least in the next few trading sessions, the way the data is slowly playing out. So what is the best strategy, you may say, if I were to design from an options perspective? Normally, when the markets have been in a range for 15 or trading sessions, really this is not a market which would work well for the traditional option sellers, because we are at that point where a directional move of minimum 400 to 500 points is setting up, and we are at the cusp of that movement. Now, after 15 days, maybe it happens on the weekly expiry day tomorrow, or it happens post the RBI event on Friday, or max on Monday. But the next 3 days, you can expect a directional move setting up in the market. If it doesn't break support, you can expect a strong pullback to 25,100. If it breaks support, you can expect downside of 24,000. So be prepared for a 400-point move either side. It is easy for me to say that, but if you were to strategize this move, how you will play out this move with options, the best possible strategy to strategize a directional move when you are not clear which way the market could go is a long strangle, where you buy both call and a put in anticipation that one of this option will become worthless or will become zero, and post a 400-point or a 500-point directional move either side, one of the options will be a 2 or a 3x kind of a doubler or a tripler, which should compensate for the losses of the other option and also see you ending up in good handsome profits collectively as a strategy. So the recommendation is you can go for buying a long straddle, not for the tomorrow's expiry, but for the next weekly expiry, where you possibly go for buying a 24,100 put on the lower end and 25,000 call on the upper end. I think you should be getting this at premiums of around 200, 250 odd levels for the coming week. 250, I think, if I'm not mistaken, maybe 250, 270. If you buy both calls and puts, I think this strategy should work well, where a direction, irrespective of whichever way it goes, should reward you. The main context in this strategy is there should be a direction, and that movement should happen within a very short time frame for us to be rewarded in this strategy. Now, people who are not comfortable with this strategy and want to take a directional bet on the market, really portfolios don't have to be worried about. They can continue to hold. Yes, for the June month, if you are open for covered call strategies, because majority of the month, I feel, looking at the market breadth is going to be more or less range bound. So you can start selling calls against these stocks which you hold in your portfolio. That should set you up well for some fixed income return against the calls which you sell. And secondly, if you were to time where I would to buy Nifty, then in case it dips, 24,000 is a good price to re-enter Nifty. If you are not getting 24,000, you want to buy it tomorrow. Whatever buying is, keep a strict stop loss below 24450. Ride some pullback rallies ahead of the bank policy if the market does give you an opportunity. So that is how the markets are positioned. Broadly, it's going to be more range bound. Sector specific, I have discussed 3 sectors which look good on the charts. Keep a watch on these sectors: infra, metals and auto. These are the sectors to bet on for the month of June as it stands right now. And I think overall the market texture continues to be positive. Just the slight dip, if we get, would offer a better opportunity. So I will end my presentation here, and we will take up the question and answer session.
Can you suggest profitable weekly and monthly strategies?
Yes. So, a lot of traders, active traders who use options to strategize themselves, set up these box trading strategies, or you can call them the short strangle strategies, which are more of a fixed income strategies, as you may call, where you sell calls and you sell puts of out of the money strikes. For example, we are at 24,500. You sell a 24,000 put and a 25,000 call, and all works well. If you end up within this range, you can just pocket in the premiums of the option premiums, which the options which you sold. That's one of the best strategies which over 80% of the traders use in the market. So I'm not talking about strategies for the current market scenario, because right now what we spoke few minutes back was more of a long strangle strategy. But if you want to use a consistent strategy in the market which would reward you at all times, I think option writing, the strategy where you sell, call and a put, you define a range, that will reward you 80% of the time of the market. The only question here is that majority of the traders set the strategy by selling naked options. Now the problem is when you have a directional move which goes sharply against you, that's where the problem arises. So we always suggest to clients that whenever you are devising such strategies, go for iron condors or a butterfly. It is similar where you define a range. The only thing is that the extreme limits beyond which if the market does show a directional move beyond the threshold limits which you define are covered by buying out of the money calls or puts. So an iron condor or a butterfly is what we always design. Irrespective of whatever you feel in the market, it is always better to be safe than to be sorry later. So always devise the range bound strategies. Go with the mindset that the markets will stay in a range most of the time, which it does, but just protect your extreme moves by buying options on either side. The best time to do the strategies is a Wednesday or a Thursday for a Nifty, because Thursday is the expiry day for the Nifty. So we will normally divide this strategy when the premiums are at their best. For a weekly, that's a Wednesday, a day before expiry, or on the expiry day in the second half. Never do strategies a day before the weekly expiry because premiums are cheap, and although the greed of getting in money faster with lesser time is there, you end up making losses in majority of the time. So I think timing wise and which strategy to use, I have discussed in this short time.
Can we hold index futures for long time investment with protective puts?
Absolutely, you can do that. Most of the investors buy index futures because if you see the journey of an index future, for example, in Nifty over last 10 or 15 year period, I think majority of the time, year on year, Nifty has rewarded the investors. So if you are investing in Nifty, ETFs is the right way to go. If margins are not a problem, futures are the best way to go. The only thing is you need to roll over them. Now really the question comes is, if you get into a situation as we are 5 months back where the markets suddenly react against you, not a sharp fall which is against what you expected, then how would you protect yourselves? So I think a protective put is a strategy where against a future you buy a put in the expectation that this acts as an insurance, that whenever things don't go your way, then the puts will help you recover your losses to a certain extent. So I think protective puts is a good strategy here to kind of safeguard your risks. But I'm more of a fan of not giving those insurance premium also, because 10 out of 8 times you will see that the puts which you bought will expire worthless and they will not actually help you hedge much of your risks. So I would suggest that whenever you buy puts, buy deep OTM puts, and also the premiums which you pay for buying the puts, sell deep OTM calls of the same premium so that your costing is almost nullified. For example, if you were to buy a 24,500 futures today with an expectation that Nifty will go up, now you will buy a 24,000 put of the next week. Let's say it comes at a premium of 20 rupees. Just an example. So if it comes at a premium of 20 rupees or 30 rupees, you buy that put. That's your outflow. Now, I do not want to give this outflow to the market because I'm sure that I have to give this to the market. So instead, to protect that 30 rupees also, I will sell a deep OTM call, probably a 25, 300 or a 400 call of 20 or 30 rupees. So net, selling a call gives me an inflow, buying a put gives me an outflow, net it is nullified, and I have a future open. So even if it falls downside, I make money from the calls I sold, I make money from the puts I bought, and if it goes up, the puts are anyway going zero. Calls, yes, to a certain extent, after 25, 300 or so, there is where my profits get halted, or I get into a situation where I do not enjoy unlimited profit. But I'm okay with such a strategy which rewards me handsomely and allows me to participate in the best of the worlds in the market. So I think this strategy, which we call as an collar strategy, would work wonders for you instead of directly buying a protective put.
What is the market view after 14 June?
Well, as I discussed in my presentation, I think RBI policy will be the key trigger for the market right now. So that next couple of days you will have a clarity as to the range which the markets have been kind of building up since the last 15 to 18 trading sessions, somewhere it has to give in either down or up. Although the broader trend is up, I personally am looking at a slight dip in the market for June, a dip till 24,000, 24,100, and if it does, that's a good entry level for you. So post 14th of June, I think I'm looking at that dip where 24,000 opens up, and I will be a buyer in case markets present me that opportunity. I think due to tariff update of US, will it affect steel and aluminum sector in the Indian market? Yes, it will affect, but it's more of a fundamental question. Unfortunately, my expertise is not in fundamentals, but the brief understanding makes what I feel is that it will affect the Indian markets, and it will affect the metal space, especially stocks with like of Nalco or Hind Copper. A sale, yes, they will have some effect on the Indian markets, is what my initial feeling is. But technically, all this space is placed well. We have seen long rollovers in the metal space, and my belief is the metal space should do well for the month of June as well.
Thank you, Akshay.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.